Welcome to this Killick Explains video and welcome to the results of another poll. This time the topic was, which of the following concepts is most important to a new investor? Actually, I could have said to any investor, but to a new investor, which matters most? And the answers I offered were as follows, with the results straight afterwards. Risk and return attracted a third of the votes, 33.3%. That was beaten by compounding or compound growth, which attracted 37.7% for the winning answer. Diversification came in at 20.3% of the votes, and bringing up the end of this particular poll in terms of popularity was opportunity cost at just 8.7%. Now, a word about each of those, but first of all, I have been pinged by a couple of people saying, aren't they all equally important? Well, they're all very important, but I think I would agree with those people who said that compounding or compound growth is possibly the most important of all. Now, just breaking down risk and return, which did attract a third of the votes after all, it's important to remember that risk comes in many different shapes and sizes. A lot of people see it as simply price risk. That's the danger that things go down as well as up over the short term. That is certainly one risk, but in addition there's liquidity risk. That's the risk you can't buy or sell at all or at the price you want to achieve, and those people in the equity market looking for indicators of liquidity risk can watch bid to offer spreads, market volumes and so on. Then there's counterparty risk, which is the risk you don't get your money back at all. Companies can go bust after all, as can other organisations and homes for your money. But it's also important to remember inflation risk. Warren Buffett's famous investing rule number one is don't lose money. And those people who don't take account of inflation risk and sit for too long in cash, for example, get poorer over the long term. And that's because at the time this video is being made, UK inflation was around 4%. The bank deposit rate available was sub 0.5%, and the gap is the amount by which you get poorer every year by staying in cash. So lots of different types of risks to weigh up and evaluate. And when it comes to returns, it's important to bear in mind that returns come in many shapes and sizes too. There is pure income, there's capital growth, and there's a mixture of the two. And it's important for investors to weigh up what type of return they're after. Now, compounding or compound growth took first place in this particular poll, and it is a key concept. Investing over the long term, allowing your money to earn interest on interest, as it's called, is a fundamental plank of investing, one of the few free lunches available, and the eighth wonder of the world, as Einstein is supposed to have called it. Now, to illustrate this, I could use many examples, but let's take somebody investing, say, £250 per month over 20 years. At a 5% growth rate. Now, that growth rate is not guaranteed. There are things to think about, like costs, like tax, like inflation, for example. But let's say you could achieve that 5% consistently. Where would you be after 20 years? And the answer is you'd have more like, well, rounding slightly, £103,000. Or to put it another way, you'd have made something like 70% on your capital invested. Now, the point about compound growth is that very few investments, other than fixed income investments, offer a steady, predictable annual return. Equities certainly don't. But the longer you stay invested, the greater your chances of generating a return that is both above inflation and also beats things like IOUs, bonds as they're called, or cash. So that's the point about compounding. It works best over long periods. Now, as for diversification, answer number 3, just want to say a word or two about that. It's the idea of not putting your eggs in one basket. And there are several ways of doing it. At the top level, it is picking different asset classes. So spreading your money around, whether those baskets are equities, bonds, property, cash, or alternatives, such as antiques, art, and so on, which are not for everyone. Then, within each bucket, take equities for example, it's the idea of diversifying across different themes, across different geographies, across sectors, across currencies, and so on, with the aim of making sure that if one part of your portfolio suffers, it doesn't bring down everything at once. Now, in fairness, systemic market risk will temporarily bring everything down, as a pandemic demonstrated, but even so, a properly diversified portfolio should normally suffer less damage than somebody who is over-focused on one particular stock, area, sector or theme. The final answer I offered was opportunity cost, and this does matter. It didn't attract a huge number of votes, but it's the idea that you should always be aware that once you put a pound to work anywhere, it could be working harder somewhere else. And a good illustration of this again is cash deposits. Of course, there's a place for cash in every investment strategy. We all need a rainy day fund, for example, to cover emergencies. We all need to have ready cash for those foreseeable calls on capital, as we call them, known amounts coming up in the relatively near future. But the point beyond that is that if you overload on cash, then your money could be earning a better return elsewhere. There is an opportunity lost, if you like. So again, going back to the long-term Barclays equity gilt study, real return on equities in the UK for the last 50 years. Past is no guide to the future, as regulators make me point out, but if you were looking at that 5% return and comparing it to cash deposits, it's pretty obvious that staying in cash for too long carries a cost, and it's called an opportunity cost. Now, I could have looked at lots of other terms, and indeed I do, but not in this video. So if you'd like to find out more, please do access our comprehensive video library, killick.com/learn, or search Killick Explains on YouTube if you prefer that as a mechanism. And if you'd like a copy of my guide on how to invest in equities, which does a lot of jargon busting, or any of my other 5 guides for that matter, please do drop me an email, editor@killick.com, and I'll be happy to provide them.